Welcome back to the M&A Zing podcast, where we explore the world of mergers and succession with acquisition entrepreneurs, holdco builders and search fund investors in the UK, Europe and beyond. I'm your host, Gareth Hawkins, co-founder and CEO of BizCrunch, one of the AI-powered tool suite for turnkey small business succession. Today's guest is also in this space and has had a front row seat to M&A activity across 4 continents over the past 2 decades. Andrew Stace has worked in Auckland, Sydney, New York and London for some of the world's leading advisory firms, including PwC, Mitsuo Greenhill, Evercore Luminis Partners, and has advised on over $60 billion worth of completed transactions. And after 20 years of doing deals the traditional way, Andrew's now disrupting the very process that he knows so well. He's the CEO and co-founder of Reccy.ai, an AI-powered due diligence platform that's transforming how data rooms are assembled and analyzed, particularly for mid-market and lower mid-market transactions. So Andrew, welcome to the M&A Zing.
Yeah, thank you very much for having me, Gareth. It's great to be here today.
It's a delight to have you with us, given your depth of experience and wealth of knowledge on M&A in general, but also with what you're doing at the bleeding edge, exciting kind of coalface of bringing AI to deal making and deal diligence. So let's get stuck in, shall we? I'd love to understand a bit more, and I'm sure our listeners would, about your 20 years in M&A across the 4 different markets, quite the career. What drew you to the space initially, and why did you stay in it for 2 decades?
Oh, good question. And I think my experience when I started, I guess my internship, first one was probably 2005, which was pre-financial crisis, and I started work in 2007. My experience was probably a lot different from a lot of people going into M&A today. And at the time, I think I took a role at PwC in New Zealand, the corporate finance team. I didn't really know what I was getting into. And New Zealand is a sophisticated market, but a small market. So you didn't have the depth of financial firms you might have in London or New York or some of the more global markets. So coming out of university, I'd studied law and commerce, and I had an opportunity to go and work for a range of firms. I ultimately chose to go into finance because it sounded more interesting than the alternatives. And I had some personal connections to the business that I was joining and respected some people who were inside the PwC corporate finance team. So did that for the internship. At the end of the internship, one of the partners took me out for lunch and said, "Would you like a job when you graduate?" And I said, "Yes, please. That means that I don't have to interview again and don't have to go through that process." And the money was good, more than I'd probably ever expected to be making straight out of university. And it was an easy decision. But going into it, I'd always thought that this might be a 2 or 3 year thing, and then I'd be off and traveling, which as it went was the case. I took a year off for most of 2010 and spent that traveling around New Zealand, doing a lot of exploring, and then a lot of time in Africa doing some travel, some exploration, and also some work with the NGO there. And then coming out of that was post the GFC. And from when I started my career in 2007 to what the world looked like in 2010 was a very different situation in finance. So sort of looked around, said, do I want to go back to New Zealand? At that time, the economy was pretty weak. Went to Sydney, ended up getting a job as an analyst in the Greenhill business there, and really enjoyed what I was doing. And as I went through it again, I don't think I went into it saying, this is going to be a 20-year journey for me. But it was a case of every time I was reaching a promotion milestone or reaching a different hurdle, I'd have an opportunity. So I think I was a junior VP at the time. The opportunity came up to go to New York, and looking around at everything available, spending some time in New York seemed like a very good idea, very exciting idea for a guy that had grown up in New Zealand, spent a bit of time in Sydney, but had never really spent meaningful time in the US. That was meant to be a 2-year deal, and then back to Sydney. And I'd always thought that I'd go back to Sydney and then reassess. About 18 months into that, the CFO of Greenhill came into my office and said, "How would you like to go to London?" And they just had a complete clean out of their VP and ED layer. And I had a British passport, so there was an opportunity to move across to London, jump in there, and continue my adventure around the world. And that meant spending a bit more time doing M&A And it was also a great opportunity to spend some time in Europe, which I'd always wanted to do. So I came across to London, and then one thing led to the next. You're into bonus cycles, you're into promotion cycles. And I was actually doing work I found really interesting. I'd become part of a very successful consumer team within Greenhill. We were doing global coverage, global leadership of the consumer practice within the business. And I was spending a lot of time with really exciting clients, doing some big transactions, and then working with two senior MDs who I had a huge amount of respect for, and as well as teaching me, helping me develop client relationships and build my own business. They're also fantastic mentors. So very long-winded way of saying it, but I think it was a case of opportunities kept on coming up that seemed and were very exciting to go and pursue. And that just kept me locked in and moving forward for the best part of 20 years now.
Sounds like a great journey, and one that spans several continents with one major investment banking household name almost. Be really interested to know, you must have got involved in some pretty exciting deals along the way. Are there any particular transactions that helped shape your thinking or stood out as being formative for you on that journey?
Yeah, I was very lucky to work on some fantastic transactions. I think when investment bankers introduce themselves, they always like to talk about the biggest deals they worked on, and that's very much an instinctive thing. And those were good. They were challenging. Working on very large global transactions, we helped when GSK, before they spun out Haleon, we helped them sell their Indian Horlicks. I spent a lot of time in India working on that, which was fascinating exposure to that market. And spending time in India, you really are at the coalface of entrepreneurship, and you see just how much hustle there is in that culture, just how much people are working to build businesses, to create, even from pretty small bases. So seeing that up close was really cool, and how a global brand had been so successful in establishing and building in India. The other things I really enjoyed were some of the smaller deals where you're actually working much closer with founders. And I'll come back to this a bit later, but if you look at large ticket M&A, it's generally a very formal process. It's all quite closely choreographed. As a general observation, the bankers, and this is particularly so in the US, the bankers have got their lane, the lawyers have got their lane, the consultants have got their lane, and it's quite formulaic what you're doing. At the very senior levels, you are doing a lot of relationship, a lot of advice. Once you start being slightly below the most senior MD on a deal, it is very formulaic. And that's not a bad thing, but I think it just means you're kept pretty tight in your lane. What I found when I was working for smaller companies and founder-led businesses was you had a huge amount more scope to talk to them as people, advise them, get involved with what's going on, and really develop a relationship as a trusted confidant for them as they think about much more than just the immediate issues around investment banking, selling the business, buying a business, the corporate finance piece. You find you get drawn much more into their business and actually learn a lot more about what it looks like inside a business. So there were several smaller deals that I did that were probably not as newsworthy for the FT or some of the other financial publications, but at a personal level, I always found very rewarding to work closely with founders and see them get a great result generally from an exit transaction.
Yeah, I think many professionals can say sort of similarly that they've learned more and they've enjoyed more and found more kind of intellectual reward, and I guess maybe sometimes emotional reward from dealing with those more agile kind of lower mid-market type opportunities, rather than being one of an army of professionals that are sort of sent to a corporate deal. So yeah, really interesting. So 20-year career doing that, advising on deals. Executing through investment banking. At some point, there's been a light bulb moment that's made you decide that actually there's something broken here that I need to go and fix. There's an opportunity here to do things differently, and I imagine that's how Reccy was born. Could you tell us a little bit about how you made the leap and why you felt motivated to do so?
Yeah, happy to. I wouldn't go as far as to say that investment banking is broken. And if I look at my career, so if I said the very first transaction I worked with on as an intern, a data room was literally still a data room. It was a windowless room somewhere in a basement with a bunch of binders in it. And as an intern, I got to put together a deal where I was doing the photocopying and filling up 5 sets of binders for different bidders.
Leafing through lots of continuous feed dot matrix printed paper.
Yeah, I think I'm not that old. So
sorry, that's just my career experience.
I'm not quite a dot matrix guy. I was probably a sort of a laser printer. Black and white was but
you young buck,
very young. And I sort of saw that investment banking quite quickly adopted virtual data rooms, and the same in data provision. I think my first couple of years we were on the Bloomberg screen, but very quickly you saw products like CapIQ and FactSet come in. So investment banking does move; it does adopt different products. But there's always opportunity to introduce new technology that will streamline a process. And ultimately, if you look at what AI is focused on within investment banking, similar to law, similar to consulting, is you have generally very expensive people, and the model of scaling simply by adding more people has a ceiling on it. Investment banking scales by the size of transactions you work on, but also by the number of people you've got working within your franchise. So tools that allow you to spread that talent across more transactions and more revenue potential are always going to be an exciting opportunity. And I was at an inflection point with my family, with where we were in the world and ultimately where we wanted to be long term. And I was not at the time working full time in the city. There was an opportunity to do something else. And I looked at where AI was going. I looked at where I believe the landscape is going to shift across, I think, most professional services, frankly, over the next 2, 3, 4, 5 years. There's a huge opportunity to deploy AI into professional services, and investment banking is a key place to look. And I looked at what LLM-based AI is good at, and I looked at what are the more time-consuming parts of the M&A journey, where often it's work that needs to be done, but often doesn't add a huge amount of value. Reviewing or doing summary reviews of data rooms, and said that is a very good application for LLM-based AI to go and help you organize a data room, help you understand what you've received, and start creating useful summaries of what you've been provided, and also allow you to sort through that information, find what you need much faster. And if I look around at a lot of firms, when a data room opens, you'll find people that are sitting there and very well-paid people, and they'll still spend the first day in a data room going through Control Fing, clicking on a few documents, skimming through in a fairly unstructured way, and really just of seeing what's in there. And if you multiply that across several people on your team all doing the same thing, quite quickly you've got tens of hours of very expensive people doing roughly the same thing without a lot of process behind it. So where Reccy jumps in is it systemizes that, it uses AI to do that initial review. So rather than having multiple people on a team skimming at random and opening a range of documents for a couple of days, you actually just can put everything through the AI and get that summary back that everyone can read and have in front of them without having to put together in a manual and often semi-random way.
I'm really intrigued by that, because I mean, obviously AI is a massive enabler now, and I think you could argue that data room technology went through a bit of a vintage. Some of it's still partying like it's 1999 in Java and things like that, where it's very much, just a glorified Google Drive that needs lots of manual navigation. So I think it's due a rejuvenation, it's due a disruption, and I think AI is a great way to do that, particularly if you're saving people that heavy lifting of having to sift through, knowing where to direct their attention is really critical. So love how you're doing that. But walk me through what happens. How you guys are differentiated from others tackling this problem. But what happens specifically when a user uploads some data? Say it's a seller, they've been asked to populate a data room by their lawyer or broker or whatever. What happens? What does Reccy go and do at that point?
Yeah. So I think first up, Reccy is not trying to be a data room platform for sellers running a competitive process. And if I look at the tools out there, you've got a plethora of platforms where you can run a sell side process. They've got Q&A functionality. They use AI for things like redaction. One of the platforms that uses AI to try to predict who your successful buyer might be, for example. It's not so much focused on making the buyer's life easier and accelerating the buyer's due diligence. It's that those platforms are centered on allowing the sell side to run an efficient, broad, competitive auction process. Whereas Reccy's more of an analysis tool than a data room platform per se. But what Reccy does is if you feed it a data room, then there are three main pieces of functionality. The first is it will review everything that's been provided, and that could be provided in any language, any major language or any common file format. Reccy will review it all. It can go and completely disorganized. Reccy will still be able to read and interpret what it's been provided, and then it will produce what we call the insights report. And we've built a standard insights report that we believe is a good common size due diligence report for a initial review of a data room. And we've built that with input from lawyers, bankers, investors, C-suite executives. That's the first main piece. If you want to customize that, then we can build you a custom insights report for you that addresses your 50 or 100 questions that you want to deal with in every data room you go into. And we can normally do that, build that, and then test that for accuracy within 24 or 48 hours maximum for you. But that insights report means that whole control Fing, that whole skimming through a data room has been dealt with. You can click refresh insights, go and grab yourself a coffee or go and grab lunch. When you come back, Reccy has read everything and produced this insights report. You can sit down, read that. Typically, a several hundred document data room will condense down to 30 to 40 pages of summary. You can read that summary and straight away have a really good understanding of what you've received by default, what you haven't received, and also what some of the emerging key risks are for you to focus on as you then think about the rest of your due diligence. The tool then has a chat function, which will be very familiar to people that have used things like chat or other AI-powered chat. You can ask it any question, and Reccy will come back and answer with reference only to the information that's been provided. And then the final main piece of functionality is the ability to summarize documents. So if you needed to get the summary for 15 lease agreements, then you can just click through those, and Reccy will generate more or less instantly a summary of the key terms of that lease agreement that you can then stack out and compare. So you've got a good handle for what the lease portfolio might look like. So that's really what the tool does. So it helps you set the roadmap. It does that initial summary, and then it gives you smart tools to very quickly go and dig deep into particular areas and come away with the more detailed insights you need. It might be you're particularly focused on contract with change of control clauses. Reccy can find those clauses very quickly and then give you direct source references and the ability to download the base document, so you can then go and dig into those in more detail. So it's a productivity tool. It's an enhancer. It's not we're not trying to compete with Intralinks or Ansarada with what we're doing. We're very much complementary to people that may already have a data room platform going.
So it will plug into third-party tools, will it? It will go into other people's data rooms, or do you need to copy the data room into Reccy?
It depends on the security settings. As a general rule, most of those platforms have very strict data control and data protections, and it's rare that users would let plugins go and access them. But the way around that is you can bulk download an Intralinks or Answer Writer data room, and then just drop that into Reccy as a zip file, and Reccy will do its work.
Brilliant. That's really, really great, game-changing. I'd love to drill in a bit more to the insights report, because that sounds like a super shortcut to knowing where to direct your attention and where the challenges or opportunities might be in the deal. How many insights as standard is the report surfacing, and on what sort of topics?
Yeah, so we've looked at, it's got 11 categories of information. And those are all your core headings. So you've got commercial, you've got strategic, you've got legal, property, tax, technology. And then under that layer of 11 categories, the Reccy will recall and return answers against 68 separate specific data points. And then behind that, there's a library of prompts we've built and tested. And that's what will generate the Reccy standard insights report. Like I said, if you want to customize that, we can customize that. There are a lot of firms that have a pretty set checklist that they might have developed over a number of years when they're doing due diligence. If they're prepared to provide that to us, then we can build prompt sets that will yield and answer their questions, and then test those for accuracy. So they've got confidence that they can run the same set of questions that might be their standard set of questions over any data room they want to, once it's inside Reccy.
Amazing. I should imagine there'll be some sort of tech natives that really love this and want to adopt it, and are fearless about it, and then there must be others that are a little more tackling it with trepidation. Normally, because there's this general concern about, well, am I making my sensitive data available to training LLMs, and what's it doing in the public realm, etc. How do you safeguard for that and make sure that those fears are allayed?
Yeah, so we work with external LLM partners where we have they offer terms of business that don't require the information to be moved into their systems and to train their models. Not all models offer that, or not all foundational LLMs offer that. Some require the information is submitted. So when we looked at the partners for us from an LLM point of view, we said terms of business are really important. We need to ensure that we're not leaking information into their models to train them and have it retained in their data sets. We also needed them to be accurate models. We also needed them to be models that performed quickly and were able to answer questions quickly. So we use a panel of providers, and they've all been selected to ensure that they hit the criteria of what we need and what we need for our users. Great.
And how do you train it such that it doesn't get into overreach and start making massive commercial recommendations to the to the way that, like, here's what you should do in your first 100 days, for example, which might attract liabilities for you?
Yeah, it's actually quite an interesting thing from a design decision, which is you can have AI can do a huge amount, but the more it does, the greater the compromise around accuracy and auditability of what it's done. So the design decisions we've made with Reccy were, it will only review information you're provided. So we're trying to minimize hallucination risk. The Reccy tool will only refer to what's in the data room that's been provided. And that does mean that it can't go out and do benchmarking analysis against the wider market. And that's a trade-off. We took the view that people want accurate answers based on what's been provided, and not have the agent go out and explore the internet at large to find answers.
So but even in the data set you're giving it, like, is it prone to speculation? Have you had to kind of curtail its enthusiasm? Because I tend to find with LLMs generally they do want to be helpful, and you have to give them really clear parameters to say, no, just I want to understand this, but not have you speculate for me.
Yeah. So when we were building all the Reccy report, and we were building the prompt sets, and we were working out how to get the right answer from information, we did spend a lot of time on this question. And we also spent a lot of time doing manual testing. So actually testing what the AI produced, and then going back to the source documents and making sure that what came through was accurate. And as you can imagine, that was a fairly tedious process. But what it does mean is that we're highly confident that the answer you get from Reccy will be accurate, will be based only on what's been provided, and it won't be trying to please you or give you an answer if none exists. So the product is built very specifically that if the information doesn't exist, it will just come back and say insufficient information provided, cannot answer. Which, if you spend a lot of time in, for example, ChatGPT, where the tool is naturally built to try to please you, naturally built to try to be as helpful as possible, Reccy will give you a slightly different experience. But if what you're trying to do is get facts on a business correct, the last thing you need is an AI tool that is using its own imagination to fill in blanks.
Completely agree. I mean, the much derided sycophancy of opium AI, I think is definitely has no place in this professional service kind of. But obviously, there are numerous other LLMs that are far more safeguarded and geared towards professional services. So good. So I think in some of your brand positioning, you what's interesting to me is you're focusing on these questions of like how deals get passed on due to lack of bandwidth in order to really conduct full, deep due diligence. That was a surprise to me, because normally my expectation is when people get that far, they want to see it through, but actually you sort of time kills deals and all that sort of stuff. So this rationing of questions that you refer to, I'd love you to elaborate on that, please.
Yeah, so that came out of my experience doing sell-side transactions, and it was something you saw a lot of in 2020, 2021, when you had a very hot market. And the mid-market, lower mid-market PE funds are actually a lot more fee sensitive than you might expect. They don't have the same level of operating or management fees coming in that the larger funds might. So they're actually, the smaller the PE funds, the more they are sort of a traditional fund where carry return is really how they pay their people, not salary and bonus on the way through. And a lot of them will say, well, and this was a US thing in a very hot market, where they would look at an IM. It doesn't take very much to take an IM, have a flick and put a number in. It's quite easy to put a bid in. You just take the forecast EBITDA and apply an industry range multiple, put in your letter, fire it to the seller, and see how you go. And at that stage, you probably haven't invested that much in a process. All you've really done is ensure you get through to the next gate and the chance to take the deal more seriously. And what you saw in 2021 was a lot of funds were getting through to that stage. And then they were seeing they had so many transactions on. They were saying, we don't actually have the time to go and do proper diligence on this deal. And if we actually go ahead with it and start hiring lawyers and external advisors to help us, very quickly you're throwing tens of thousands of dollars or pounds onto your fee clock. And in a number of cases I saw, the fund would actually just pause, tell you that they're just hanging around the hoop and not move forward with the transaction because they either didn't have the fee budget or didn't have the team bandwidth. So
it's almost like we never expected it to be so complicated.
Yeah, I think it's more just a transaction. You only really want to commit to a deal once you know you have a very high chance of winning it if you want it. And what you saw sell-side advisors doing, and you almost had a sort of negative circle feedback loop going, where sell-side advisors would say, well, a lot of these bidders are flaky, so rather than moving 3 or 4 into the next phase, we're going to take through 6 or 8. Then the bidders all knew that they were now, rather than one of 3 with a pretty good shot to win, they're now one of 6 or 8, and it gets a whole lot more speculative. So you just saw the preparedness to invest heavily in a transaction before you had exclusivity or before you had some better sense you might win this, drove a lot of funds I saw to slow walk once they were in DD, hang around the hoop for a while, and actually try to see what's happening in the process before they really charged in.
That's interesting. But then in turn, though, they must be almost opting out of more deals as a consequence of that behavior. So they then have to have more deals as a sort of more broader funnel in order to make sure that they actually are able to get some of them closed, surely.
Yeah, I mean,
or get to high conviction on enough.
It's a classic thing on the sell side, which is you always want more competitive tension, and that's always what you're trying to achieve. But there are actually times where it can become counterproductive if there's too much noise around an asset and bidders take the view that they're so unlikely to win, it's not worth going after. If I extrapolate that through to where we are now in the cycle, and if I look at private equity funds, again, mid-market, low mid-market funds or investors, you're seeing a lot of funds struggling to re-raise. You're seeing a lot of funds with some very stale inventory of assets. You're seeing a lot of funds where they are losing their investment talent and they're becoming more almost just holding pens for stale assets that they haven't been able to exit. So you do have a huge amount more fee sensitivity in that universe. And actually, you went from a world where spending on external advice was generally not questioned as long as the deal had been supported by the IC, to a point now where before an IC or before a fund might commit the tens of thousands of dollars to start doing due diligence, they actually need to get higher conviction that they have a good chance to win and higher conviction that they are, this is a deal they want. So if you look at that and say, well, what can AI do there? AI can help them get a much higher level of conviction by doing all that heavy lifting, doing all the review of a data room, and then they can go back to their investment committee or the CFO of the fund and say, we want to go at this. We've looked at the data room. We've got a good sense of what's in there. Sign off the budget. Let's really go at this now. So it means that decision to invest the time and the money is a much more qualified decision than what it might have been before you had AI tools.
Yeah, but that cost and time saving, which is obviously inherent in what AI can deliver there, makes a lot of sense. Yep. But the behavioural changes, I guess, that you're getting as a consequence of this are sort of a little bit less expected. And so I'd love to understand a little bit more about what you're seeing, how this plays out in practice, particularly in small PE funds or in corporate finance. Like, how is their maybe deal origination and their deal execution changing as a consequence of having access to this kind of tools? You got any examples you could share?
I think with deal execution, a good one is a client recently. They had M&A budget to do one transaction, but they had 3 that were live at the same time, and small team would not be able to diligence 3 assets separately in parallel, even with outside help. And what they were able to do was use Reccy to accelerate the due diligence and look at more assets at the same time. So when they ultimately said, this is the one we're really going to go for, and this is the transaction we're going to focus on, they'd had a chance to push more deals through to a later stage of assessment before they actually really went for the one they wanted to win. So I think you're going to see now funds taking more deals through to a later stage, because the opportunity cost and the financial cost of moving into a data room, having a decent look at a business, learning more about it before they make that stop go, that's now moved from being a expensive decision because of time and cost of the people that are involved to a very cheap decision if you're prepared to run your data room and materials through AI agents.
So that, I guess, will lead to more deals getting further, but then stalling because actually there's a deeper triage going on. I guess like these funds, these investors have the ability to get really deep into the data room without necessarily having to fully use that as a sign of commitment that they're going to take the deal to fruition. I guess but maybe sellers should steel themselves a bit more for the fact that probably they're going to get a lot more, I don't want to say tire kickers, but speculators getting to that later stage who don't necessarily themselves have the highest conviction. So maybe does that mean that the seller needs more, is this going to just breed more competitive processes because the advisors behind those sellers need to make sure that they don't be left with nobody at the altar for the marriage to happen?
I think for sellers, and certainly if advising on the sell side, the challenge of taking bidders through to a data room and investing time in them was always, how serious are they? How credible are they? And one of the signals you always use was, have they employed engaged lawyers? Have they engaged accountants? Are they spending real money doing due diligence? And generally, until a bidder was investing real time and cash to look at a transaction, you take the view that they perhaps aren't serious about following through. So
that's going to happen later now. That commitment of time.
Tools like Reccy are going to confuse that, and those signals, I think, now will be harder to pick up, because you can see that people will get into a data room, they'll be active, they'll be able to do a lot of work, but they won't necessarily have the same dynamic where they've started putting real dollars down to investigate the transaction. So I think that's an interesting dynamic, and the sell side is going to have to look for new signals for how do you actually know if someone's a serious bidder. But what I think it will mean, though, is you're going to have less attrition through a process where less parties will drop out simply because of bandwidth issues. So from a sell side point of view, you might be able to push more bidders later in a process and get to a stage where you're getting a larger number of final binding bids that are now no longer conditional on diligence. And from a sell side point of view, that's always, having more unconditional bids is always going to be better than less. So that's how I would look at it changing from the seller's point of view.
Well, that's important too, and it's got quite a nice kind of maybe unintended positive consequence of that, wherein the DD that's happening should be more expeditious, and the offers that come straight after that shouldn't be scuppered by any kind of sudden skeletons in the closet or anything that was unexpected, because there's more thoroughness being done earlier in trying to surface these blockers.
Yeah, and I think that's true across the whole workflow of M&A now. That if it's not Reccy, there are other tools out there that help you build valuations much faster, help you model much faster. I don't think that the number of transactions is going to increase markedly because of AI technology, but I think the speed with which firms can look at deals, do all their work, value things, build financial models, complete due diligence, get to a position where they're ready to go forward with a binding transaction, no longer conditional. I think that window is going to compress, because a focused team using a full toolbox of AI tools can do the full suite of work for an M&A transaction in a fraction of the time it used to take. And I think the firms that are going to win out of the cycle are the firms that are able to turn AI tools and AI-powered enablement of their process into speed and deals. Because all things equal, if you're the seller of an asset, faster is always going to be better for you. So if buyers that are really harnessing the power of AI tools are in a process and using that to shrink how long it takes them to do their full workup, do their diligence, do their modeling, do the valuation, get funded, then that is going to make the seller's life easier, and it's going to reward the buyers that can be decisive, can move fast, and can actually harness these tools.
So maybe not more deals, but just faster, more efficient, more cost-effective deals as a consequence of these tools.
I think so. If you go back to manual diligence, full process, maybe it was taking you 3 to 6 months to get a transaction done. Maybe there was 8 to 10 weeks of due diligence. Maybe there was 6 weeks of building and reviewing an IM, building a model, and putting in an indicative bid, because you just needed the time to go through and do that work. If AI starts shredding those timeframes, then the time period you need from an asset coming to market to completing a transaction shortens markedly, because you're still going through all the same gates. I don't think we're going to see that the standards of diligence drop, or I don't think we're going to see the benchmarks drop, but the speed at which you can get through the different gates that you need to get through to satisfy all your stakeholders to support a transaction there's going to be a step change in that. I'm very confident of that.
I should like to think so, and glad to hear that Reccy is well placed to be driving that.
Yeah.
Just as a slight aside, you're a man that's seen the world. You've worked on several continents, yet you've thankfully decided to launch and form Reccy in the UK. Anything in particular that led to that decision, as this being a jurisdiction for this product?
The UK has a very strong fintech ecosystem. It has fantastic talent density. It has a time zone that allows you to service most other places in the world. If I sit there and I look at my sort of world clock, London actually has some level of overlap in work hours with pretty much every jurisdiction with which you might be working. So there are huge advantages about being in the UK. You've got the proximity to Europe. You've got the language into the US. So from where you sit, you can access the major markets, and you've got a fantastic talent density coming out of the universities, coming out of companies that have been successful that maybe have been exited, coming back, and you're now getting into the second or third generation of people that might have already been through a couple of exits and are now back in the market, often with some money in their own pocket, which they're investing and or founding new companies. So I know there's a lot of discussion and there's a lot of talk about where in the world, and people are always going to have their own view on that. But I think the UK has a number of very good advantages for founders, and the ability to get things done is better than most places I've been in terms of your administrative processes. And the other piece is the evolving depth of capital market here, the speed at which the UK is now generating capital, generating VC investors, funds that have done very well out of some globally significant exits. That money is all now being recycled back into the UK tech ecosystem. So the funding dynamic now versus where it might have been 5 or 6 years ago is totally different. Yes, there is a gap still to what the US might have, but certainly for the vast majority of companies that are starting out, there's definitely capital available. There's definitely a supportive investor base, and there are lots of advantages of being here.
Wow, what a refreshingly uplifting review of the state of the UK. Thank you so much for that, Andrew. That's high praise, and really, delightful to hear, particularly amidst all the naysaying and the doom mongering that went on around the budget. And I mean, I was guilty of it too. But actually, when we look at it through a pair of eyes like yours, how wonderful to hear the opportunities that exist in the UK. Thank you for sharing that.
I think it's very easy to sit somewhere and look at the US or look at the Middle East or look at somewhere else and say that it seems better. And your natural inclination is to look at somewhere else and think about all of its good features and not actually look at any of the trade-offs you might be making. And if I look at the UK, a lot of people in business here and around the budget, there's a very strong sense that people were always finding what was better somewhere else, but didn't spend enough time, at least in my view, saying, well, what does the UK really bring? What does it have to offer? And if I look at the journey of AI, no doubt some of the US companies are better funded and making bigger headlines with bigger numbers. But if you look at the foundational science behind AI, if you look at some of the more innovative startups coming through, the UK definitely holds its own, definitely punches well above its weight in terms of what the ecosystem is really starting to generate here.
Yeah, I mean, let's not forget that Demis Hassabis started DeepMind here, and a lot of the the science behind Gemini, and it is grown out of King's Cross, London. So I think that there's huge talent here. My hope is that T-Sport and the sort of world leading future data center that's going to appear on our coast is actually going to give us more sovereignty over some of our AI technology, because I think we are a little bit heavily dependent on the valley at the moment, from a perspective of foundation models anyway.
Yeah. My own personal view on this is a strong commitment to cheap, abundant energy would be one of the more powerful things that could happen. And if I look at where things are evolving, you look at data centers, you look at how much energy they consume, and you look at where that's going to go, and the implication for an economy that's already facing some of the highest electricity prices in the world. A resolute, strong commitment to ensuring that UK power prices are going to be as low as possible would do a huge amount to support data center activity, would do a huge amount to support innovation, would do a huge amount to support the AI ecosystem and its growth. So I've just spent quite a lot of time talking about what all the good things were. But I do, on the other hand, I do definitely believe that the energy prices and the electricity prices will hold back development of AI, because it comes down to a basic competitiveness issue when you're looking at large data centers, where to locate, what it costs to run those things.
This is where the legacy of being a first mover in electrical infrastructure now comes back to bite us, because we've got all that rejuvenation, regeneration cost that has to be borne somewhere. I'm long on small modular reactors myself. I think they're gonna change the scene here. Anyway, we digress. So fast forwarding 12 months, love to get your take on where you feel Reccy might be, what your kind of personal hopes and dreams might be for it, but also how it might have impacted the sort of M&A landscape beyond due diligence. What might you next be disrupting?
Yeah, so we're focused for the time being on bootstrapping what we're building, and we steadily adding customers, steadily growing, and ensuring that the tool we've built is properly useful to our audience. And if I said, who's our real audience here, we're going after the mid-market, the lower mid-market, because the preponderance of AI and finance that I see, and there are some fantastic tools out there. There's been some great headlines recently in the UK about some homegrown talent. They're generally focusing on the largest funds, the largest banks, the largest customers for long-term enterprise deals. And that will be a phenomenally successful business for them, I'm absolutely sure. But the flip side of that is I think they're not doing as much, or they're not as focused on the smaller funds, the smaller advisors, the people doing smaller transactions, because those sorts of customers can't do $25,000 a seat for a year on long-term contracts. So what we're trying to do is build a tool that is responsive, that is priced at an accessible price point, and is flexible enough that funds that are not, or M&A advisors that are not spending all day, every day looking at data rooms, or not spending all day, every day using AI tools, they can actually use our product, understand it, get a huge amount of value out of it, and generate a very high ROI versus what the product's going to cost them. And as I look forward to what's going to happen next year and where AI is, I think you've had a huge amount of hype and discussion the last 18 months. You've seen a huge number of firms go out and buy a bunch of products, bring things in, start testing. Those budgets have been spent, in many cases stretched. I think what you're going to see next year is a lot more scrutiny on tools, on ROI, on we're spending this much money on this tool for every single user. Are we really getting the returns from this? Is the team really using it? Or actually, in practice, are they still just using their own personal chat subscription, or are they still just using the basic tools? So we're trying to ensure, and what we're trying to do with Reccy is ensure that the ROI for the tool is always going to be very strong, even if you're a relatively small firm or you're going after relatively small deals. That's ready to be.
Yeah, I love it. You're seeing a similar kind of pattern and maturity or maturing playing out in the adjacent legal tech space with things like Legora and Harvey, where firms rushed to embrace them, but then maybe didn't get the immediate return on them that they set out to. So now there's this like renewed kind of, hang on a minute, how can we ensure we really use them to the fullest? So I think that's going to happen. It's very early in the M&A space. You're probably one of a few that are really innovating here.
Yeah, look, I think we're very comfortable where we are and what we're doing. But if I look at where some of the foundational model owners are going to go, don't forget they've taken in tens of billions of investment. They need to get a return on that at some point. And they can't get a return on that doing consumer AI for people helping with LinkedIn posts and those things easily when they're not for a free subscription. What they really need to get the return is either plug directly into the shopping and the consumer journey in the way you're now seeing with chat. You've basically got a direct ability to buy something straight out of your chat, or they need to start going into places which are much more enterprise focused. And my expectation is that the foundational LLMs are going to start going after higher value services like law, higher value services like finance, and start moving into those markets pretty aggressively. I'm sure you saw the headline that Chat had hired, or OpenAI had hired, a couple of hundred investment bankers to sit there and train models on what does an analyst do, what does an associate do. They're not.
Yep, saw that.
They're not doing that to offer that to people for free. I mean, that's going to come out, I'm sure, as a OpenAI for finance type product, which will be expensive, but still cheaper than what some of the bespoke solutions being developed might be.
Yeah, I'm still very bullish on Anthropic. I think they've done a great job with Claude of already tackling financial services, and professional services tasks really well. Good. Well, we could talk all day on this one, Andrew, and I would be delighted to. I'm sure we'll do a beer at some point. But let's just sort of maybe finish on a high with maybe one piece of advice you might think about giving somebody conducting due diligence in the mid-market M&A space. If they're still sitting on the fence about adopting new technology in their processes, what kind of nugget could you give them to think on over Christmas?
I guess sitting there on a sell side, the speed and certainty was always what you wanted. And you might get half a dozen relatively undifferentiated bids on value. They all generally congregate towards a similar place. The party that won transactions was almost invariably the one that got onto it early, moved fast, and got conditions out of their bid as soon as possible. So if you're looking at assets, if you're looking to win competitive processes, the faster you can get through that diligence phase and the faster you can get an unconditional bid in front of the seller, the more likely you are to win a process.
Beautiful. Yep, that's certainly a motivator. Andrew, it's been fascinating. Thank you so much. For our listeners who might be curious about Reccy and want to learn a bit more, perhaps even take it for a test drive, where might you direct them to go?
Just go and look at our website. We're at Reccy.ai. There you can see more about the product. You can see some testimonials, some screenshots of the tool in action. And if you're keen to book a demo, you can either book an appointment through that and let us share the product, or you can jump in and create a demo account and have a play with the tool.
Awesome. Bit of sales-led, bit of product-led. Love that. Okay, so Andrew Stace, CEO, co-founder of Reccy.ai. Thanks so much for joining us on the M&A Zing. We'll share all those links in the show notes. Listeners, if you've enjoyed this episode, please subscribe, leave us a review, share it with anyone in your network who's involved in or interested in SMB M&A. We'll be back soon with another fascinating conversation from the world of deal making. But until then, keep on crunching.
Thank you very much, Gareth.